I've run across many people over my financial planning career who are investing for their future but have no strategy, no game plan, and no knowledge on how the investing game works. Because let's be honest, the entire system is packed with landmines, and if you don't understand how to detect them, they can blow up your financial future. So today I'm going to share the top three investment mistakes that I avoid to make more money and how you can avoid them too. Let's start with the first mistake, which is timing the market is impossible and can be a costly mistake. I've made this mistake multiple times, especially early on when I just started investing, where I buy a stock, it goes up and down, and then it has a nice bump, and I continue to hang on to it. It continues to go up, and in my head, I'm thinking, I can't let this go. It's doing so well. And then the next day, it plummets. And I'm like, no, I should have sold it. Now, I've also done it in reverse where I'll have a stock in mind to buy, but I felt like it was too expensive. So I waited and waited and kept waiting, and it kept going up throughout this entire period, and it never came back down. So if you've experienced this, it can be very frustrating. This happened to a lot of people who went through the 2008 market crash, where they sold at the bottom in 2008 and then waited to get back into the market, some waiting much longer than others. And for those that did wait, they missed out on participating in the 400% growth in the S&P 500 from 2008 to 2019 forever. Now, if you were younger, you have more time on your side to make it up, so it maybe didn't hurt you as bad, but even still, making this mistake can be irreversible. So if you think you can time the market, you're wrong, and it can end up being a very costly mistake. Even the top mutual fund managers in the world can't do it right all the time because there will always be variables they can't predict. Consider these two charts. The first chart on the left shows when the best days have happened in the market, referring to the S&P 500 index from 1994 to 2023. And 50% of the time, the best days have been during a bear market. 28% of the time, they were during the first 2 months of a bull market, and 22% of the time, they were during the rest of the bull market. If we move to the right, another chart shows how costly it can be if you missed the best days in the market. So in this chart, we are assuming growth of $10,000 investing in the S&P 500 through 1994 to 2023. If you stayed fully invested throughout this entire period, you would have just over $181,000. Now here's the drastic difference. If you miss the market's 10 best days over this 30-year period, your return would literally be cut in half. And missing 30 of the best days reduces your return by 83%. So, given how unpredictable everything is in the world, it's highly unlikely we can guess when these best days will be. And this is exactly why trying to time the market is so difficult. But this doesn't mean you can't take advantage of rising and falling markets. A strategy that works well for many investors is to automate your investing schedule by transferring money to your investment account on a specific day every month. Having it on autopilot like this eliminates the possibility of your emotions getting involved with whatever the market is doing that day. And your goal is to take emotion almost completely out of the investing process as much as possible. Because when we do have these bear markets and uncertainty sets in, we feel like we need to do something when really the best decision is to do nothing. When you invest on a set schedule with the same amount of money each month or week, the fluctuations of the market work to increase your gains and not decrease them. The second investment mistake is selling in a down market. Down markets are likely to happen throughout every single year, but here's a statistic that's really important to understand. Since 1980 until now, the average intra-year drop is minus 14.2%. But with that said, even with the market dropping an average of 14% per year, annual returns since 1980 have been positive 75% of the time. And all that means is just because we have a large decline in the middle of the calendar year, that doesn't mean the market won't end the year positive. Pretty interesting. Take the year COVID hit as an example. The market dropped 34% during that year, but ended the year positive, up 16%. So understanding this alone can help prevent you from making sudden, spur-of-the-moment trading mistakes. Because when you sell in a down market, you are locking in a loss, and you have to make a significant amount more on the upside to get back to where you started. They call this the drawdown effect. If you lost 50% in investment, you need to make a 100% return just to get back to even. A couple tips that I do to avoid this mistake is I don't buy individual stocks for my long-term investments anymore. I lean towards ETFs now, simply because within one ETF, I can be diversified throughout 100 stocks as opposed to just one company. It's lower risk, and now if one stock does go to the tank, there's 99 other stocks within that fund to offset it. Another tip is if you still want to buy stocks, just use a much smaller amount of your life savings to do so and be okay with the fact that you might lose it. Having buckets of your money assigned to different goals like this will help you not only manage risk, but also your emotions when investing. The third investment mistake is checking your accounts every single day or even multiple times a day. Now, let me explain. I'm not saying to ignore your investments, but speaking from experience, I was in a situation where I put a lot of money into one stock and was checking it multiple times a day because I was literally paranoid about what it was doing. One day it'd be up and the next day it'd be down. One day it was up 35 grand and I didn't sell it because I kept telling myself, what if it continues? It can go higher. Let's just wait one more day. And then it dropped $40,000 and they ended up selling it, losing some, but not all of it, thank God. Now, there are folks out there that I've worked with that are well diversified. They're putting money into their accounts and they still check it daily. They watch the news way too much, and I cannot explain to you how much extra stress this can bring into your life. So, diversify your investments to your comfort level, automate a way to contribute money into the account to avoid market timing, and set it and forget it. Check it once a month, maybe once a quarter, and if you can, have the portfolio rebalanced a couple times a year. That will most certainly help as well. So do those things, you will set yourself up for long-term investing success. Thank you all for watching this video. If you got value from the video, please consider subscribing to the channel, and I will catch you on the next one.